It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, 2 a.m. in Sydney, 9 a.m. in San Francisco, and 9:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream Series 25, Episode 4. That makes episode number 148 starts here. Now, given the dramatic electoral upheaval in France of late, you might expect a strike at Euronext to be taking place there. But actually, it's not Paris, where the far-left CGT Trades Union holds sway over the Euronext staff. Actually, it's down south in Italy, where Borsa di Milano staff are feeling unloved. Meanwhile, EEX can't buy Nasdaq's Scandi Electric markets because antitrust. But elsewhere in Brussels, they want to create a top-down monopoly for stocks and derivatives. Internal communications, anybody? Here's a fun fact, ladies and gentlemen. In buying Preqin, BlackRock have made the founders of Preqin, Mark and Lindy O'Hare, who own 80%, worth $2 billion out of a $2.5 billion deal. Actually, no, sorry, a £2.5 billion deal. So their payday is equivalent to $2.5 billion, which means pretty much each of them is worth more than Larry Fink, who comes in somewhere around a mere 1.2 to 1.3 billion. Lastly, ladies and gentlemen, what a week and what an anniversary. It's the 25th anniversary of none other than this book, Capital Market Revolution, my first book, which with remarkable prescience, I do feel, foretold the future of markets in an online world. Published by FT, we're bringing out a special 25th anniversary ebook edition. Stay tuned for that, ladies and gentlemen. Meanwhile, I promised a scoop today on IPO-VID in Exchange Invest, and here it is. Well, how on earth do you celebrate the 20th anniversary of the first best-selling book of the fintech genre? Well, we're about to receive an incredible accolade, ladies and gentlemen. I'm off to New York tomorrow because on Friday, President Lynn Martin of that great and august institution, the New York Stock Exchange, has invited me to ring the closing bell. Yes, indeed, ladies and gentlemen, we'll catch you Friday on the Nicey live feeds on CNBC, on Bloomberg, anywhere in the world. You know, fun fact, 100 million people watch the Nicey bell ringing daily. So catch me 4 o'clock Eastern time on Friday live on your choice of financial television for some great campanology and those vital 3 gavel bashes. We'll be reporting in due course from the NYSE and telling you all about the wild excitement of what goes on. Speaking of wild excitement, what a terrific show we have today. Our guest is Danny Corrigan. Our topic, Repo and the London Reporting House. Danny Corrigan, if you haven't met him, and I can't believe you haven't, ladies and gentlemen, is Mr. Repo. With over 35 years' experience of wholesale markets derivatives as a London-based CEO, MD, and director, he has worked across the repo, debt, derivatives, trading, clearing, and broking industries. Danny's global experience includes spells in Sydney, Tokyo, and Moscow with big names, including CME, ICAP, ING, and NatWest, amongst others. Danny co-led the development of the market infrastructure for gilt repo, central clearing of repos, LCH's ground clearing repo clear product of 1999, and also the SFE's bond and repo clear between 2000 and 2003, as well as pioneering trade reporting between 2012 and 2016. There's so much to talk about. We could be here just discussing Danny's bios and the many infamous, wondrous, great positions that he's held, but instead, let's get to the nitty-gritty. Hello, Danny Corrigan. Greetings. Where in the world are you today?
Young, good morning where you are. Well, I'm in Bow Lane, just off Cheapside, in our lovely little headquarters of London Reporting House, equidistant between the Williamson Tavern and La Taverna Etrusca, Italian restaurant to the right, well known by many. So in the heart of the city.
Yeah, so how far does that place you from the Bow Wine Vaults?
Oh, spitting distance.
Barely a couple of 100 meters more. And if you want to go way, way, way out of your way, you can go to somewhere wonderful like Sweetings for lunch. You're making me hungry, Danny, actually, coming up for lunch.
Downhill to Sweetings.
In Eastern Standard Time. That's awesome. That is truly the epicenter of a very, very historic part of the city with origins going all the way back to ancient Roman times and before. What an amazing place. So when did you move into those offices?
We moved in 2 years ago. the offices were rented by Kaizen Reporting of the Kaizen RegTech Group, who we partnered with then from April 2022, and they had this office effectively left over when they were moved to WeWork and subsequently into the Gherkin, or the Pickle as it's known to Americans. So we were in this lovely office, and there's at times here up to about 10 of us, and we've been the tenants here since then.
Fantastic altogether. So Danny, tell us, how did you get into financial markets?
Well, I think I was always planned to do something like this. And, Patrick, you know some history and stuff like that, but I was good at economics at school. In fact, I got a prize from the Inner London Education Authority. I found it the other day for my A-level in economics, but I was always going down that line. I went off to Liverpool to study under Patrick Minford, did an economics degree there, but I had no idea what to do afterwards. I had applied and got a job in an accountancy firm, and I just couldn't do it at all, and so I didn't show up, shamefully. But I was sitting at home very early, and the Evening Standard lunchtime edition came out, and there was a job advertised at Dun & Bradstreet, financial reporting firm, American firm, going hundreds of years. I applied for that. I was the first one in, it turns out. I had an interview and got the job almost within days, as things were those days. Terrible place, terrible job, but a great place to start in terms of it's always good to start with a bad place. And that sort of gave me an idea, it was sort of credit training and so forth, and it gave me an idea to get into financial markets. Fast forward, the boss of the Australian office came over, and he said if I turned up over there, they'd offer me a job. They did. Worked there for a bit, and then I went to work for a merchant bank over there. That's how it kind of started. But in terms of financial markets, I returned to London, working for State Bank in New South Wales on Fenchurch Street. I was doing an MBA in the evenings. And what happened there was I was on this course, and it was a great course, very thorough. And, turning points, and I can remember exactly where I was sitting with, and turning points in career. And there was a senior guy called David from Chemical Bank, and I said, he's a top marketing guy. I said, that's exactly what I want to do. I want to do market in the lending space, because that's what I was doing at the time for the bank. And he said, that's what you don't want to do. What you want to do is what we just learned in the last lesson, which was we were doing a 10-week course on finance as part of the MBA, and 10-week on futures and options, led by Professor Desmond Fitzgerald, who I got to know then. Actually, what happened was when I finished the course, checked in my job as you do, when I saw a tiny little advert in this, and this is how I really then got into it. One, I was looking to go this route. We'd at the bank, I'd go in after each lecture and say we should be doing this, that, and the other. We did. We did the first interest rate swap the bank had ever done, because that's the thesis I did. And so I went down that line basically, and then went to there was an advert in the Financial Times, and it was tiny, a little box on a Thursday when they used to look for people, and it said MBA wanted for arbitrage. So I wrote to them and said, I've got an MBA and I do arbitrage, because actually technically that's what I was doing by that stage. And they interviewed me. I went around to their office, and it was a beautiful office. It was where the Bronte sisters had their books published, 65 Cornhill. Hadn't changed since those days. And interview was going very well. And I said, well, why'd you put such a small ad in the paper? And they said, well, actually, we've already got the bloke that we want. But he's Greek, and it's not in the European Union, and we have to advertise the job. I said, oh, well, why did you bring me in? They said, oh, well, we like you anyhow, so we'll hire both of you. And that's how I got into it. It was Alexander's Discount House, formed in 1810. And it was to help build their gilt business. That was just before Big Bang. So that's really how it started. And then Desmond Fitzgerald, of all things, turned up as the head of economics and strategy at the wider group, Alexander Langer Cruikshank. And so the friendship developed from there, and it was very much a working friendship. And he wrote the first paper I'd ever read on repo, saying there should be a repo market in gilts. And so they all sort of went down that line, as it were. So fortuitous conversations. And I'd say at that stage, that was properly in the financial markets, whereas before it's broader capital markets in bond, in loans and so forth.
What an incredible story, Danny. That's absolutely fascinating all round. And yes, it's amazing to think that still in the mid-1980s, just as Big Bang was happening, the amazing power that the discount houses still had over all of London. And I mean, nowadays you virtually don't hear that they even exist anymore, even though they're there somewhere. But I suppose in a way, actually, discount houses partly got taken out by the repo business in essence, along with all the other things.
Yeah, Black Friday, Black Wednesday, Black or White Wednesday, that took out the discount houses, to be honest, because what had happened until then is monetary policy was obviously targeting in interest rates, and what the Bank of England would do, keep the market short every day, and it led money against securities so that the target rate that was set at that stage, it was really very much by the HM Treasury as well as the Bank of England to make sure that rate was set. They'd be lending money every day, up to 4 times a day. But what actually happened is they'd only lend it against bank bills, not against gilts, not against government debt. And that's truly historical, because in the old days, corporate debt was better value than government debt. Yep. But there wasn't enough of it. And what actually happened is on a particular Wednesday, when sterling was exited the exchange rate mechanism, there just wasn't enough money. There wasn't enough collateral in the market in bank bills. So the Bank of England lent money to the market against gilts, against no legal agreement, and that was the Wednesday for settlement the Friday. And by the Friday, a number of people had signed up agreements. There was no such thing as a master repurchase agreement. It was cobbled together, and that facility lasted from then from 92 until January 1996, when an open gilt repo market came along. But that killed the discount houses, because they were the ones that knew all the bank bills were. They were the ones that, you know what it's like. If there was end of the day, there was a shortage in the market and you still need to borrow money, the CEO would put on a top hat and walk down Cornhill and the likes of Cornhill, Old Broad Street and so forth, to the Bank of England, take a right to the discount window, which is there to this day, and say, we did this amount of money against this collateral on behalf of the banks in the market. And extraordinary. That was still going on from 86 on until, well, it continued way beyond 96, but it was doomed from 92 onwards.
Yeah, from 92 onwards. That's very interesting, and probably one of the things that nobody thinks about really in terms of what were the ramifications of that incredible time. I remember being on the live floor, but I've bored the viewers about that previously with all sorts of incredible numbers when volatility was just in orbit. I mean, it was beyond higher than anything Elon Musk has managed to propel a rocket at so far. But he'll get there sooner or later, I'm sure, past it. So, you were there. You were there for the birth of the repo market in London. You were doing these sorts of things. What was your first posting where you went overseas? Because you've been to some fabulously glamorous places.
Well, as I said, with the first job with Dun & Bradstreet was in Australia, but the first in the financial markets was was with Alexander's. Alexander Langer Cruikshank was owned by the Mercantile House Group. It was a very adventurous, ambitious group. And they had opened an office in Tokyo, so I put my hand up for that. I went out to Tokyo in 1997, which was fantastic. It was, there was, the whole idea that there was a wall of money coming from Japan, and what they'd want to do is buy gilts from a tiny little discount house in a group they'd never heard of. Was ambitious, but it was developing. Globalization was developing very early on. And that was at the time, of course, when Nikkei Dow was 39,500. There was plenty of money there. So I went out there, and that all worked very well. And when I came back, I realized that the repo market was starting up. So not the gilt repo at that stage, but the rest of it was, because you would remember better than anyone, Patrick, that the Bund contract had been launched, I think, in 88. And that was basically, people were buying bonds and selling futures. But for that basis trade to really work, often worked the other way: sell a basis, sell a bond, reverse in the bonds, and buy futures. And that reverse repo meant that especially the American banks developed the repo market in those currencies. And because I'd done that MBA under Desmond, I understood all about basis trading. So I joined Bear Stearns, where I was set to run at the repo desk. But I used to do it all from the idea of what was cheapest to deliver, or TED spreads trading and so forth, from a relative value angle. So so came back from Japan, did that, and then variously went abroad again after that, spectacularly to Russia in 97, where we made and lost a fortune. Came out square, was the way Phil Bruce described at the end. Working for Renaissance Capital, 6 of us left NatWest, 5 came back. Never know what happened to the 6th. And then I basically came back from there. And then I got into RepoClear. I've been working with the wonderful David Hardy, Philip Bruce, and Sarah Williams. By the way, you never asked me this, but I'd tell you, she's the smartest person I've met in the entire financial markets for 40 years. Sarah Williams was the MD that she and David and Phil Bruce had set up RepoClear, which is, of course, then SwapClear, of course, is the mainstay between the valuation now on the Stock Exchange Group. The three people deserve a lot for that. Anyhow, got involved in that, did that in London, the front guy for that, and then did the same in Australia. And last piece on this is I went to New York on 10th of September, 2001.
2001.
To do the same with FICC, GSCC. It was to take central clearing they already had out to their clients, and of course that lasted a day. And then with the attacks on the World Trade Center, that was curtailed, of course. So that was
incredible, because if I remember correctly, I mean, total tragedy, obviously, and all of those sorts of elements. But looking at it from a very, very clinical market structural perspective, one of the biggest problems was that actually there was, I mean, basically the GSCC was sitting on a vast amount of bond certificates in its basement. And there was actually a concern that, what happens if we can't actually reach the certificates, if I remember correctly?
Yeah, they did a spectacular job, GSCC, because we evacuated the building, and then secretly, I remember there's a guy called Tom Costa that ran that part of the business. He basically said, you go home, you go to the disaster recovery site in Brooklyn, or you come upstairs with me again. And they stayed for about 4 or 5 days in the office on their own. And they had, they did a good job. I think that's what you said is without doubt almost probably true. And to this day, the market they never squared the market. And it wasn't because of GSCC, it's because so much trading was done in treasuries and repo that hadn't already been booked, that when people tried to reconcile at the end of the day, and given so many people souls were lost, never really got worked out. And in the end, it was, they did the best of the job. But GSCC did a fabulous job, as did a number of brokers, as did Cantor Fitzgerald, by the way, given they lost 600 people.
Well, that's what I was going to say. Yeah, I mean, yeah. Cantor must have been responsible for a huge number of trades that weren't booked, but what they managed to actually work out was incredible, given how many people were killed. And I mean, if I remember correctly, in fact, even the CEO's brother was killed in the middle of it all, wasn't he? I mean, it's absolutely horrific, the damage that was rented asunder that company and a number of other firms that were in the Twin Towers.
But the repo market came to the aid of that there, and a guy in London called Clive Triance, who's now very senior at the Australian Stock Exchange, and Dave Moody, who you probably know, they basically, I believe that they saved Cantor Fitzgerald. They were in London, lost lots of their friends, went to the States, were in terrible offices, but put that right. But it was the repo market that oiled it all there, and because there's such a well-developed repo market in the US anyhow, that despite all the terrible things that happened, it kept it going, and that's what happened there.
Well, that's incredible. And I think that's an apt moment for me to say, first of all, hi, ladies and gentlemen. Welcome to this show. You're watching an introduction to both Danny Corrigan, Repo, and the London Reporting House. That's 3, isn't it? Tripartite. So therefore, if you've got any questions, anything you'd like to know, let us know. Ask a question. Send us a little heart, if you would, ladies and gentlemen. Help people understand and love the repo market. It's vitally important. You've heard of I Love New York. For some reason, I Love Repo hasn't caught on as a t-shirt yet, but it should if you understood how important it was to the world's financial markets, which therefore, for those of us who are not in the know, Danny, explain to us, what is repo?
So it's been around forever. It's short for the term repurchase. And it's this. You know, in the interbank market, banks historically would lend money to each other unsecured, but they'd only lend it, you know, for a certain period of time and a certain size. Then what happened? They started developing actually in the States in 1919 with bankers' acceptances as collateral. You could always lend probably 10 times the amount if you had security, and the banks started to work this out amongst themselves. Is that, you know, I've got a $10 million credit line for you, but actually I can do $100 million worth of business if you give me $100 million worth of cash. So I'll give you $100 million cash, you give me $100 million worth of securities. And so it meant instead of it being unsecured, the risk was minimal if you did that, but also you took what's called a haircut. So I can lend you 10 million unsecured or 100 million secured, but what I'm going to do is I'm going to lend you 90 million and we'll keep that 10 million as a haircut. That's a 10% haircut. It took off in America, never stopped. And, you know, by and large what we were doing in discount houses as well, but in America it was very well developed. It was done with government securities, and the whole idea is this. I lend you the money. So what happens is you sell your securities to me, and I reverse them in. So by you doing, you do a sale and repurchase, and you get the cash from me, and I get the bonds from you. And at a predetermined date, we do the reverse. You give me the cash back, I give you the bonds. Delivery versus payment through a settlement depository. In the States, it's the US Treasury. Here, it's Euroclear, Clearstream, and so forth. But with that haircut, that 10%, very much like a credit card. You go to a bank and say credit card, they say, all right, 10 grand. They say, how much can I have for a mortgage? Well, if your loan to value is this, you can have 100,000. So it's a concept of security. The banks love that. The regulators love that. Basel III, the end game, will come to that in a second, loves that. They're saying if you have good collateral and it's mark to market and there's a legal agreement that covers you in the event of default, that's great. If you're lending money unsecured, you're a mug. And that's what's happened. So sale and repurchase means repo. And there's a repo against reverse. So if I reverse the securities in, that means I'm lending money. If I'm borrowing money, if you're that's reverse repo, and a repo is the same transaction seen from the counterparty side. So each repo and reverse repo match.
And they, as you mentioned earlier on, go through a clearinghouse somewhere on the way, like Repo Clear at the London Clearinghouse and so on these days. So therefore, the amount of, in inverted commas, safety within the system is quite considerable.
Yeah, for sure. So what happened was, first of all, you needed a repo agreement. And we didn't know what to do because we didn't have one. So we all met at the In and Out Club on Piccadilly to say, we could use the US market, and it was called the Bond Market Association document. But we thought we needed a trade association around it. So we went to see what was the AIBD, Association of International Bond Dealers. They decided that, we set up a committee with them. And then basically we took that document, went to see some great lawyers in London. There's a guy called Chris Giorgio, Alan Overy, and Habib Martani at Clifford Chance, and it became what it is now, the Global Master Repurchase Agreement. So you could do a whole series of transactions, buys and sells, repurchase and a repo under that agreement. And then what? So as soon as you had that bilateral market that was full of confidence, people were basically doing more and more and more. There's certain advantages to it as well. It really took off in 1999 when London Clearing House, against the odds, set up Repo Clear, which was they interposed themselves between the seller and the buyer. So if you had two firms, like say that was NatWest doing a repo trade with Deutsche Bank, it would go NatWest, LCH, Deutsche Bank, NatWest, LCH. It's the Deutsche Bank, LCH, NatWest, and that came in. Trades came in as matched, and it grew and grew and grew and grew. It was a little bit like the tipping point you see in Malcolm Gladwell's books. It took a little bit of time, but it took off, flourished. It came in before SwapClear, which was a tremendous innovation, even though SwapClear was supposed to be before, and I'll say for the following reason. And the SwapClear should have gone forward quicker. The FTC had issued a no-action letter, but it didn't because we required all participants to sign an NDA, and that was struggling. They didn't know what NDAs were, a lot of the trading managers and stuff. So Repo Clear, we didn't do that. We skipped that thing, that idea, requirement for an NDA, and it came first. And to this day, I think, just my personal view, NDAs are not worth an enormous amount. Anyhow, Repo Clear came in, SwapClear came in. The rest of the world copied it later on, and now you see what the US is doing, exactly what LCH did. They're taking FICC, and other firms are entering that market. CME has announced they are, and as is ICE, your friend ICE, all our friends ICE.
Everybody's friend at ICE, I think, these days. That's such an interesting organization. But yeah, very, 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 very intriguing stuff. So looking at the repo market, who are the users of repo? I mean, all financial institutions.
Patrick, this is a great question, because one of the points is we're going to talk about later on is where it goes next. The users of it is extraordinary. So, and there's a little bit of a plug, but what we'll do with Repo Clear, those days are gone. London Reporting House is, we've been, and I'll explain a little bit more about that as we go along, but basically we're using tremendous data that we're receiving from our clients. It's repurposed regulatory reporting data. And we know from that there's an enormous amount of firms that are involved in the repo market. So in the securities lending market generally, it's about 17,000, in the European Union, a bit less in the UK, but a lot. Repos alone, there's about 4,000 in each country. So that's doing repos. So, by the way, for derivatives, multiply it by 10. These are numbers that you get from ESMA. But so there's probably 6, 7, 8,000 in Europe institutions, and so it is. There's three different kinds of actors in the market. There's institutions, there's professional traders, and there's retail. We know the institutions are in there because we can actually see that now with the data we're getting, which is we know, of course, it's banks, broker-dealers, asset managers, hedge funds, but it goes way beyond that now. So you get the classifications as EMEA, one of the definitions that come out from the European Union. You can see the taxonomy was there, but it's way, way, way beyond that. And Patrick, when you look at it, you see it's not a pool of liquidity. There's puddles of liquidity connected by canals, and the participants in it go way, way beyond you'd expect in that, what we're calling that whole institutional market, into the professional market as well. And so hedge funds are doing systematic trades now. So banks doing systematically internalized trades as well as the normal business. Then you get the systematic trades. Hedge funds, prop firms are doing some of that as well. So it's not just people that you know and love, which is broker-dealers who need to borrow money from banks, or hedge funds that want term leverage, or asset managers who just want to enhance their performance by lending a few bonds through by doing repo. Way beyond that. That's really important. It actually all starts with the central banks. The central banks issue cash to the market and take bonds in. And they've been very generous over the last few years with long-term repos and so forth. So that central bank money feeds commercial bank money, which gets fed through that top layer, as we said, which is institutional, banks, asset managers, hedge funds, and so forth. But then into the next level down, the professionals in the proprietary trading firms. Now, it hasn't got to retail yet, Patrick. Prohibited with gilt repo. And you think, in the end, we'll have a conversation a bit about this in a second, but, it's touching point that for securities financing transactions, be they repo or securities lending, the repo market, the retail market will get involved, and it's coming soon.
And that's fascinating because one thing that, just to take it back, because we'll go to retail in a minute and where the repo market goes next as a whole. What intrigues me there is how much did the landscape of repo change after 2008? In other words, when central counterparty clearing was mandated for so much OTC trading, was that a catalyst for other financial institutions to get into the market, or were they already creeping into the market because of repo clear, etc., before then?
Great question, Patrick. Basel II was the killer of the unsecured market. And that was being, with Basel II, what was going on is it was being shadowed anyhow before 2008. So unsecured money hated, secure money loved. So unsecured money with no collateral against that. And the regulator said, if you do unsecured trading like certificates of deposits, the amount of reg capital you have to put up is in this following equation. Very, very high. And that was new. That was coming in. So a number of firms that were in that market that were basically issuing certificates of deposit ran into trouble because they were issuing 3, 6, and 12-month certificates of deposit. So as that year went along, they couldn't issue any more 12 months because it was being shadowed, and they couldn't issue any more 6 months and then 3 months. And if you look at it, the reason Northern Rock went under, they couldn't issue any more 3-month CDs in September of 08, I think September 07 or 08, I'm not sure, but it was the September because it came in the following year, and that's when they went under, was because they couldn't issue anymore. So they needed to get into the repo market because they had good collateral, as did others, but just you couldn't open the market up quick enough. So the building societies weren't doing repo then, and they are doing repo now. And a lot of firms that weren't in the repo market because it was seen as an institutional thing, it was seen as a big bank thing, have now entered the market because, I'll tell you this, Patrick, in the financial crisis, a lot of firms wouldn't have gone under had they mobilized their collateral a lot better, including credit repo. They had it sitting there doing nothing in custodians, and had they mobilized that under the Global Master Purchase Agreement, they could have raised cash. They wouldn't have had to go to the government for funding. But the catalyst for it was that. But the real catalyst was September 09, the Pittsburgh meeting of the G20, where they said from now on it has to be about the following, and it's automated trading, central clearing, and regulatory reporting by all participants in a timely fashion in a universally identical way, two sides of the trades. Now, that was all about derivatives. People remember there's like 5 points in that statement, but it was a sixth, and that was repo was included that the US never picked up on, but we have picked up until now, but we did in Europe and so forth. So yeah, you're absolutely right. That was the catalyst for it. It was coming in, didn't help at all with the sovereign debt crisis because it was too soon. But Dodd-Frank 2010, EMIR 2012, LIFE 2014, and then SFTR 2016 on to 20. Those regimes, the financial crisis caused a problem, and it really underpinned repo. It underpinned automated trading, essentially clearing and reporting, but the repo market. And also the vast amounts of money put in by the European Union and other central banks into the market led that, as I said, that comes to central bank money, gets converted to commercial bank money, and that was the mainstay. The withdrawal of it, Patrick, in recent years, a couple of recent years, has meant that you haven't seen a lot more commercial bank repo, so bigger banks in Spain and Italy supporting the smaller banks in those countries.
That's very interesting. I'd love to get back to some of the granular issues with the banks. But first of all, we've got a fantastic question coming in here from John Falk. Great to see you, John. Thank you very much for joining. And thank you again for such a terrific question. Danny, does the size of the market increase as it goes through the layers, the various layers, as you have described? What happens if there is a seizure for whatever reason in one of the layers?
Look, it's a great question because we're looking at this right now, and from our data, there's 20 trading venues in the repo market and about 30 brokerage firms in the UK and European Union. And so it's a multi-layered market. We keep using this expression, so thank you, the word layers. Multi-layered. 20 trading venues and 30 brokerage firms. It's immense. So what actually happens is you can execute repo through a number of these, but there's no one institution in all of those. We know that much. Typically, though, so long as the central bank's putting enough money in, and what we used to call the settlement banks, but those who have access to either the ECB or the Bank of England, has enough balance sheet, it should work. Commercial bank money, central bank money basically effectively through its balance sheet. But it's really quite important. You said there is there's a seizure, and one of the seizures is through a balance sheet. The banks just haven't got the balance sheet capacity for it, so they don't trade a lot of it themselves. They don't run the matchbooks they used to be, which was about reversing securities in for a period of time and putting them out for a shorter period of time, or helping finance clients. So that is one of the points that RWA, the risk-weighted assets, is a real problem, as is some of the LCR, the liquidity ratios that have to be created. So those are, if you will, they're defaults, and if they're not managed properly, you won't see the cash come through central bank money into commercial bank money. Now, the Bank of England has recently announced this, as it takes down the quantitative easing, as it basically sells assets and takes down the amount, aims for lower bank reserves. They're going to be using the repo market much more intraday as well, probably the same way they used to. I think that's a point of failure, because not that they're going to fail on it, but it just means that there's going to be so much need to make sure that the cash can get to where it can be. Can I also just add in that to John, in that it's not just that. The whole idea is that the Bank of England lends money at the appropriate rate for the entire economy, and that's a monetary policy, fiscal policy, trade policy. It's all supposed to come together, and that figure is supposed to be what's right given the inflationary conditions and inflationary expectations. But they don't know whether that money, if they lend it at 5.25%, really goes down to the end at 5.25%, and of course it doesn't. And that's something that they're going to have to work on. But yeah, I agree with you. There could be a seizure at some of that. But the great thing about it is there's just not a pool, as I say. There are distinct puddles of liquidity. And so long as you've got your wits about you, and you've got the ability to trade in automatic fashion and centrally clear, it shouldn't happen. But all to be tested, because we're in a new world completely.
Gosh, Danny, after that fantastic answer to that brilliant question from John Falk, I'm going to give you a second to repose, have a glass of water or something, and we're going to come back to you in just a moment. What I want to talk about now, ladies and gentlemen, is every week we choose a book of the week. This week, our book is none other than Good Derivatives by a former guest on IPO-VID, the Professor, the Doc, as he's known in Chicago, Richard Sander. Good Derivatives tells the story of the Chicago Climate Exchange. It tells the story of how markets solve problems. As you may remember when we talked on IPO-VID, we were discussing how effectively, once upon a time, everybody thought acid rain was the bogeyman that was going to wipe out humanity. Yet, as soon as they managed to bring in all sorts of NOx and sulfurous contracts in Chicago itself, hey presto, people had an economic incentive to get rid of that acid rain, and we do not have remotely the same problems to this day. Good Derivatives is a story all about those particular issues and how markets work, even on the most contentious areas relating to climate change and everything around it. That's a fabulous story altogether. Another fabulous story that we have upcoming, of course, and I'm sorry, I'm milking this today because, well, I'm excited, ladies and gentlemen. Who wouldn't be? It's like having a knighthood in financial markets. Capital Market Revolution, 25 years old this week, and we're off to celebrate on Friday afternoon by ringing the bell at the New York Stock Exchange. And those of you who've been astutely watching our social media will know, we've been preparing a series of short videos all about the wonders of campanology via the lens of the New York Stock Exchange and bourses as a whole. Let's have a look at one of those videos. Meanwhile, in Big World, the modern age of nicey bell ringing as a massive communications mechanism dates back to March the 28th, 1985. Where the nicey bell has always signalled the power of the world's most famous market opening and closing, it fell to that consummate communicator, President Ronald Reagan, to kickstart the addition of a message to the process of defining the trading day. The 40th president took to the podium early in his second term and delivered one of his typically bravura performances. As he stated in his speech before the opening bell,
the surest way to make American products more competitive is to spur innovation, enterprise, and productivity by cutting tax rates again.
It was a full-blooded manifesto for free markets, as he added,
with tax reform and budget control, our economy will be free to expand to its full potential, driving the bears back into permanent hibernation. That's our economic program for the next 4 years. We're going to turn the bull loose.
We're going to turn the bull loose made headlines around the world as the world's media warmed to the notion of watching this market open as theatre of market advocacy. For more in Big World, like or follow. So there you have it, ladies and gentlemen. We've had incredible people like Shinzo Abe, the wonderful, incredible Ronald Reagan, and many others ringing that bell at the New York Stock Exchange. And on Friday afternoon, it's going to be me for the closing bell. Tune in at 4 o'clock Eastern time. That's 2200 hours if you're in Central European time. And watch. It's going to be a fabulous extravaganza. I'm really looking forward to it. Thank you so much to Lynn Martin and everyone at the NICE team for this invitation. Truly an absolutely wonderful opportunity and a shock to the system. One great thing, actually, Danny, bringing you back into the conversation here, our guest, Danny Corrigan, we're talking about the world of Repo and the London reporting house. Actually, it's quite funny. You can't see it because of the format, the vertical format of that video, but it's originally shot horizontal. And apart from that security guy who has his eyes beadily trained across all of those cunning floor traders who are out there and looking terrified that there could be somebody trying to take out Ronald Reagan, as indeed, of course, somebody tried famously during his presidency. Just to his right-hand side, actually, it's magnificent. You got Donald Regan, the then Treasury Secretary, and he looks like the most nervous man on earth because he knows that if that bell doesn't go off at 9:30 exactly and Ronald Reagan is a second too long, there's going to be mass terror and the world's markets will go wrong, which I think we can all recall in famous moments in times past, Danny, where I can recall at least one launch of a product at Life. I think it was short gilts where they were launching it. And when they launched the short gilt or the medium gilt contract, the man from the Bank of England was still talking with 30 seconds before the bell, at which point in time all the traders ignored him and started calling prices at each other. Anyway, Danny, look, we've talked about the repo market. We're going to come back to that in a minute, but I want to understand here. Obviously, data is a mega issue in this whole process. Reporting data is huge because, as you mentioned, of course, we had all of those sorts of amazing things like the 2009 agreement after that famous, infamous, one might say, meeting of the G20 post 2007, 2008. What is the London Reporting House and what is its function to serve the repo market?
So, Patrick, as we rightly said, from 2009 onwards, one of the three legs of that stool was to do post-trade transaction reporting. So all institutions in certain jurisdictions had to report, or G20 had to report their trades. In this case, it's repo, securities lending, and margin lending. And it's called SFT, SFTR, Securities Financing Transaction Reporting, came in. It was announced in 2016, really got going in 2020. Accurate data for the last 2 years or so. And what it is banks have to report, these banks, asset managers, hedge funds, money market funds, all kind of institutions apart from central bank and retail have to report in the same way to a chosen trade repository and the two that matter most are DTCC. It's actually DDRL is a subsidiary of the DTCC group in the States. So DTCC is the market leader across the world. And in Europe, they are, along with Regis TR, and actually London Stock Exchange's Univista still does some business there. They were particularly good at the start. So what happens is each firm reports in their side of the transaction, and the other counterparty has to report their side in as well. Sometimes banks do it on behalf of clients, but in SFTR, not really. So the transactions come in. The trade repositories have to make sure that basically that the right fields are completed in the right kind of way. They make those available to the regulator FCA in Europe and the FCA in the UK and ESMA in Europe. And what those competent authorities do is make it available to the prudential regulators as well, and any other one that qualifies. So it goes in. There's a hub, and it's called Trace in Europe, and it goes off to can be up to 100 different regulators, other competent authorities, prudential regulators in Europe, and the same in the UK. Now, what happened with that data? There's a generally held view that data was rubbish in quality and no one used it. Both those things are myths. I knew this when I was at CME. I was CEO of the trade repositories there along with Dan Jude, myself, and Tim Hartley. We set that up. We always knew the data was great. From the first week in, we paired with CME 100%. So we through something called an inter-TR reconciliation. Data has always been good. It's fantastic in the following way. Now, in that, there's been a whole series of refits by the regulators, and it's got better and better and better. Our partner is called Kaizen Reporting, and what they do for a living is the following. They do assurance testing, and they're one of those firms that made a city in London what it is, and it's a firm, they're the best in the world at doing one simple thing, which is this. Clients come to them, up to 200 big clients, and say, can you check the reports are correct? And they do, and they say if it's right or wrong, or where it's right or wrong, and they put it right. That's everything from New Zealand through the provinces of Canada. A bunch of people sitting there in the gherkin doing that. So what happened was they do that. So if it's been through, it has to go through a trade repository, it gets to them, they check it, so it's fine, and it's advise on the improvements. Then we do a simple series test as well. So you know by that stage the data's great. But there's so much data, and another myth was why so much data? It couldn't have been better. So much data for both sides allows, if you know what you're doing, and only if you know what you're doing, so you get the approval from the client to pull the data from the trade repository. It comes in every night from all transactions going, have to be in by the end of the night, in the same format across all the trade repositories, all the reporting entities, 4,000 in Europe, 4,000 in the UK. And we talk to the clients, they give us permission to pull that data, and then we anonymize it, we aggregate it, we have certain confidentiality rules, and we create certain things from that. And we just started with Repo, and we said there we can work out what's called the Repo curve, the general collateral curve there, work out what bonds are trading, just specifically. They're not at all specific for individual use, but they're just called general collateral. It means people will lend money against any one of the 90 or so gilts and so forth. Then there's something called specials, that ones that are really, really in demand. So we come up with GC and the curve from it, we come up with specials. That kind of information just isn't available, has never been available since Phoenician times. We go back there, Patrick, to Phoenician times. It was never available. But also got great data on haircuts. If there are haircuts in the European market, we have that. And then certain things in terms of for market books for collateral purposes. That's just the start. But it's in 36 currencies, in 72 markets, from US Treasury bills down to defaulted Chinese real estate debt. Defaulted, because the stump still sits in Repo. And go through the whole chain, if you want to go through there, go through the big bond markets, the G7s, so Treasuries, and then the JGB market, and all the way through EGBs, gilts, and so forth. So governments, sovereigns, supranationals, agencies, credit bonds, and so forth, right the way down. We've got about 88,000 bonds. And we can see from that then, for the last 2 years, where it's traded on Repo, which is, that's not been possible before. Before, you couldn't find a curve that represented real trades, and these are the golden source. So under Basel III, which is called, you probably noticed, the end game, which is a great thing for traders going forward. It is the end game. Under the fundamental review of the trading book, it's a golden source. And so you could use it for mark-to-market purposes with no extra add-on for capital and so forth. So great data, not being used before. Could have been done in EMEA, could have been done for EMEA rates, FX, commodities and so forth. Hasn't been. But we've just done the minimum viable product to see it works. And we've went live last Tuesday, Monday or Tuesday. Worked a treat, and we're getting the data in through some great founder banks, through the trade repository. DTCC have been spectacular with us, through to us. And we've got a brilliant technology team, including the data team, for us to take it in. It's fully secure. It's AWS. The data is held and retained by the clients, and we aggregate that data and we make it available back to them and other people in what's called a give to get model. Last thing on this, Patrick, the street loves give to get models. Reminds them of going to a student party, bring a bottle party. You give them out and you get a lot more back, because if you've got 5% of the market, you could all of a sudden be getting 25% back, because everyone that contributes can get back, but only those that contribute can get it. Reuters started it that way. They did a great job. There's a fantastic bunch of guys from Data Explorers, ex-Lehman in the 90s did the same, and our friends at Market did the same for credit default swaps. Street loves it. We've done that, and works a treat. So that's what we're doing. It's using data. It's there. People have spent all the money. It's accurate, and why not use it? That's what we say.
Fabulous altogether. And so the give to get model, it's basically people throw in their data and then they get a certain amount of the revenue back that's accrued off the overall data pool, or how does it work?
Well, we'd love to do that with them. To be honest, what they do is this: they're quite happy to, so they sign up under a subscription agreement that's been designed by my co-founder, Ben Corrigan. The co-founders are Ben Corrigan and Richard Komoto. They, under a subscription agreement, they pay a small amount to this process, but what they do is they get a much better, brighter picture of the repo markets they're in, and other repo markets they know nothing about. That's their interest. And what they do, Patrick, is they either take it through our UI, our system, or just API. They just drop it in with all their other curves to see, does it actually provide a better picture for pricing of other new issues themselves, or basically, for their entire business, and it throws up all kinds of opportunities. You can see what's going on. U.S. Treasury market. There's a regular calendar of reissues. What's special? What's not special? What's that one bond against another? It looks cheap. Why is it cheap against another, and so forth. So, if you're curious, and it's for the financial voyeur like yourself, Patrick, a financial voyeur, it's great for that. So yes, it's a subscription agreement. They pay. It's not a great deal. We've got a great deal at the moment. People want to join right now, get it free to test for a few months, or we'd welcome into our lovely little office here on Bow Lane so they can come over, look at the system, and it's open to all. Anyone with SFTR reporting requirement, bank, asset manager, hedge fund, prop trading firm, whatever, is more than welcome to join if they meet those requirements.
That's fabulous altogether, Danny. Thank you very much for explaining that. And I suppose the one question that I have that jumps out at me is, I'm trying to think my way through. I mean, obviously, there is a lot of delinquent Chinese property developer paper around at the moment, but I can't quite see what's in it for the other side of the trade on that repo. Presumably, the haircut must be quite substantial.
Patrick, when I was in Russia, the Minfin bonds went down to 4.5 bid, because they didn't default. It was called a moratorium, which meant I'll pay you when I can. And we always thought it was going to be like the old days when, the Soviet Union debt. But it was Soviet Union paper. It wasn't quite clear why Russia was going to pick up the whole debt for that. So it traded at 4.5. It's as good as defaulted. Patrick, that went off the board 10 years later at 130 cents in the dollar. So it's talk about bottom fishing. That's there. Yeah. And it's because it's defaulted. What about Lehman paper? I was kindly seconded back to LCH to do the Riemann unwind, where I met a young guy called Dan Maguire. He was the trainee, well, not quite trainee, but he was the young guy on the desk to work with me on this stuff. And that we basically gave them back 150 million quid after 2 weeks of unwinding the positions. Their paper was trading 130 cents in the dollar at the end because Lehman Brothers Europe, Lehman Brothers International did not go broke. Right. So the gig is, if you find stuff down there, it's not for the faint-hearted. Yeah. No. But if someone could lend you money against it with enough, they'll do it with enough a haircut, and Red Capital works for them. Yeah, it's that. honestly, that's not the, you've got cocoa bonds are in there, all that kind of stuff. But truth is, there's something in this for everyone. There's pools and puddles of liquidity. Depends on what your interest is. You've got to take a look. It's there, Patrick.
Quite fascinating altogether. So, Danny, I mean, this has been a fascinating discussion from start to finish. We've been really, really intrigued. In many ways, I'm going to wrap two questions into one and let you go for it, because on one side, I'm really interested to hear from you where you actually think the repo market is going to go next from your salient viewpoint as the data maven of Mr. Repo at London Reporting House. And also, of course, I'm going to roll in our classic final question. Where do you think the capital market revolution goes next?
Shall I start with that one, Patrick, or do you want to start with the repo?
Whichever you prefer, Danny. Go for it.
Look, I'm going to give a bit of color on this. In that I think we're in a dollar decade at the moment. And, the US economy is firing on all cylinders. They've got cheap energy. They've got a truly working free trade agreement with Canada and Mexico. It's not a customs union where there's prohibition. It just works a treat. The American economy is going well, regardless of what's going on in elections. It's going really well. But also, the Americans have just done, they were slow on the uptake after Pittsburgh 09, not for derivatives, but they were in repo. They didn't do any of these things. Well, they're bringing in 4 things next year. Mandatory central clearing for treasuries and repo, mandatory haircuts for non-centrally cleared, and 2 other forms around reporting that they're going to have to do to the SEC and so forth. So that, in that respect, that market, the markets will grow. So I think what will happen is the repo markets will continue to grow because central banks will have to take the level of reserves down. We're going to get in a big battle about rewarding banks holding reserves in a country like the UK where there are no minimum reserve requirements and so forth. But that's it. But I say dollar will be the main pull, and that will pull all the repo markets along, including the European one. So I think it's the international. It's Europe and the rest of the world against the US. The US will develop fast. Ours will as well because central banks won't be there so much money. But the real direction for the capital market revolution. So Patrick, I first met you in a coffee shop. There's many of those in Sydney, and we met there at about 99 or 2000, just coming off the success with London Clearing House, David Hardy's London Clearing House. I thought I'd do the same in Sydney. So the family, we moved there, and I was meeting you. Didn't know what you looked like, but there was a bookshop around the corner that had your book. So I sat in a coffee shop with it, and I thought, he's going to spot me, and he did, and that friendship started from there. So what's going to happen in those 25 years, which is also 25 years from Repo Clear, which started in started in July. My God, it's this month. That must be a party. They haven't told us about it, Patrick. If they haven't, they've forgotten it. It's 25 years. So
they don't know their own history, Danny. They haven't worked it out yet. They don't.
I'm going to call them up straight away. Believe me. Yep. I think the next thing is this. It's got to be retail. And why I'm saying that is because why not? Why, after the fall of the Silicon Valley Bank and a number of other things, if you've got your money sitting overnight in a bank, or even worse, sitting on a month's deposit, something happens at Silicon Valley Bank where 40% is pulled out in a day, as can happen, why would you do that? But if you're allowed to lend your money overnight through a swing facility to do reverse in something like either invest in a money market fund or reverse repo, if that happens, so any money you've got doesn't stay unsecured, it's sent overnight into the repo market, and you could pick your collateral. Why not? That would just make sense. I know that would be good for mankind. That would be good for risk of individuals. It would be good for the banks because it diversify their funding base. Yep. And the reason not to do it before was there was a view that it would allow speculation. So what have we got in speculation equities right now? You would have all heard about Robinhood last year and so forth, where people that basically they all get together and they either buy a stock or sell a stock or whatever. If you sell a stock, you've got to reverse it in America. If you're short, you can't have a naked short. You have to reverse the security in beforehand. They have no access to that market. As they do, the prime brokers know where everything is, and they have superior information. It's truly asymmetric, and you can't get that. Now, that will change with this reporting requirements from the US, in that they will be publishing that quite soon. Patrick, there was 3,000 replies to the SEC when they put the call for evidence on this. So I think what will happen is we'll see obvious things like access to retail. So access to professional trader, let's start with that, the mid one. So we said there's institutional, professionals and retail, certainly with professionals, get them in there because they know what they're doing, and they can diversify their cash, and they can basically leverage their positions. And then I think with on the financing all round for retail, why shouldn't it be that way? Why shouldn't it be with your Revolut card that you can short equities, borrow them? There's no reason at all why you shouldn't, apart from the fact there are certain vested interests in securities lending markets, not the repo market, the securities lending markets, which would not like that at all because it levels the playing field.
And on that fascinating and thought-provoking moment, which expands further the Reddit retail concept, the whole of the world of markets and everything that's around it, Danny, I want to say thank you very, very much. This has been a great discussion for IPO-VID 148, discussing Repo and the London Reporting House with Mr. Repo himself, Danny Corrigan. Danny, I hope we can get you back one of these days and have a chat about some of the other things that are happening. And actually, we'd love to hear about how the London Reporting House goes, because that sounds like such a fascinating venture with Kaizen altogether. There is no IPO-VID next week, ladies and gentlemen, because I am in New York and it's a bit frantic. We're going to be back, though, because we've got a very special show coming up in the middle of the month. So stay tuned for our next live episode. In the meantime, I just want to say a big thank you to John Falk for being such a fantastic regular guest and asking questions. Thank you to all those of you who've left us a little love today. It's important to get us up through those AI algorithms on YouTube, LinkedIn, or wherever you've been watching this show. At the same time, let me say a huge word of thanks to our production team today, to Fernando, to Janella, and indeed to Marianne for making this a smooth and effortless IPO-VID. Danny Corrigan, this has been a magnificent show. Thank you very much for being a part of IPO-VID. My name is Patrick L. Young. I'm off. Don't forget, just in case you didn't hear earlier, to ring the bell of the New York Stock Exchange on Friday. Be there, 10 o'clock Eastern time, or 10 o'clock Central European time, 4 o'clock Eastern, 9 o'clock London time. I wish you all a great week in life and markets. We'll be back soon with IPO-VID. Thanks for watching.
Thanks a million, Patrick. Thank you.